Saturday, April 23rd, 2022, Monaco 64, home of alternative economics and contrarian views. So with all that's going on in the world, it's really biblical, I would say. It gets to the idea of the four horsemen of the apocalypse. You've got pestilence, you've got war, you've got the rebalancing of the scales, and then you have famine. And I'm not going to go over that today, but today we're going to look at the financial situation. And I tweeted out yesterday what it felt like, the financial markets right now. It felt like we're trying to navigate around Cape Horn, and we're going to come to Cape Horn in a minute. So yes, I think we're navigating through a financial maelstrom, and I think not every ship is going to survive its trip or its cruise around Cape Horn. It's very tough, and even those that are, in my opinion, fit to go around the Cape, so to speak, are going to have a very tough time. I think a lot of the passengers in those ships are going to have a tough time, even though I think they will be on the right ship. A lot of them will get seasick along the way, and it's not a nice feeling. Before we look into that, though, I'd like to talk a little bit about my background, because I was just thinking today, because all of you know that, or most of you know that I'm a keen golfer. I've been golfing almost all my life since I was 15. But before that, though, growing up in Brazil, I was actually a sailor. I used to sail because my father was a very keen yachtsman. He started out probably in the late 40s as a teenager, maybe a little older, early 50s. And he didn't have his own boat. He sailed for people who had big yachts, who did races like from Rio to Buenos Aires. Eventually he sailed from Bermuda to Copenhagen, big transatlantic races. And usually he was the navigator. He used to do the navigation, because it's not just about the wind and the currents. You need to know where you're going. So the navigation part of sailing or any kind of seafaring, I would say, is the technical part. It's the charting part, and knowing what the weather and the wind and the currents are going to do is more the fundamental part. So you can get one right, but if you get the other one wrong, you're in trouble. So you need to always look at both, I think, and that's probably one of the reasons why in the financial markets, I think I've always liked looking at both fundamentals and technicals. And yes, I always wanted to join my dad on the big sailboat when I was younger, but no, I had to start from basic on the dinghy, as you can see here. And while my father was on a big boat, on this boat here is not his boat, it's a friend's boat. I think they were sailing the Cowes Week in the south of England, and he was doing the navigating. He always did the navigating. He had his own boat as well. And eventually, after I grew up, he allowed me to go on the big boat, and he showed me how to use paper charts. And he did have the latest navigating equipment. I remember he had GPS back in the 70s. So, but he always reverted back. He always thought it was important to have the basics, the fundamentals, which is the paper chart, the sliding ruler. He taught me how to use that when we were sailing up the coast of Brazil back in the late 80s. We sailed all the way up the coast of Brazil into the Amazon and back out. And it was a fairly smooth cruising, I would say. And the toughest part, though, was getting out of the Amazon. There's an island at the mouth of the Amazon when you come out. And I didn't think much of it, but it was the roughest sea I've ever encountered. It was really rough, but eventually we got past that. And yeah, we finished off in Trinidad and Tobago. We even saw Devil's Island on the way. But back to navigating. So, and Cape Horn. So I tweeted out yesterday that the financial markets felt like this picture, Cape Horn. Some of you might not know about Cape Horn. Well, Cape Horn is down at the tip of South America, in Chile, Argentina area there, in Patagonia. And prior to the Panama Canal being completed and built, well, I think it was completed in 1914. And also prior to the first transcontinental railroad being built and completed in 1869, a lot of the trade was done. A lot of the trading vessels had to always go around Cape Horn, and it's a very treacherous stretch of sea, and there are a lot of accidents and a lot of shipwrecks there. So I just wanted to read a little bit about Cape Horn to you. And if you think about navigating, yes, you know where Cape Horn is, you know the course, you're following the compass, you're using all the equipment. But if you don't know about the weather and the fundamentals, you can get shipwrecked. And I think that's the kind of condition that we're in right now. And I'm going to come to the markets in a minute, but I just wanted to give you an idea about Cape Horn. So it was a historic trade route from the 18th to the early 20th centuries. Cape Horn was a part of the Clipper routes, which carried much of the world's trade. Sailing ships sailed around the Horn carrying wool, grain, and gold from Australia back to Europe. These included the windjammers in the heyday of the great grain race of the 1930s. Much trade was carried around the Horn between Europe and the Far East, and trade and passenger ships traveled between the coasts of the United States via the Horn. The Horn exacted a heavy toll from shipping, however, owing to the extremely hazardous combination of conditions there. The only facilities in the vicinity able to service or supply a ship or provide medical care were in the Falkland Islands. The business there were so notorious for price gouging that damaged ships were sometimes abandoned at Port Stanley. So it continues. While most companies switched to steamers and later used the Panama Canal, German steel-hulled sailing ships like the Flying P-liners were designed since the 1890s to withstand the weather conditions around the Horn, as they specialized in the South American nitrate trade and later the Australian grain trade. None of them were lost traveling around the Horn, but some, like the mighty Preußen, were victims of collisions in the busy English Channel. So, yeah, they're designed to withstand the conditions. So this is the kind of conditions I think, that's the analogy I have right now for the financial markets. So, and I think I was talking about how there are some ships who are going to survive this financial maelstrom. And I think those ships are going to be those made of hard assets. And the paper assets, I think, are going to be, they're going to be in trouble around Cape Horn, the financial Cape Horn. And why do I think that? Well, because it's a rebalancing of the scales we've lived for too long, I would say since 1971, with a monetary system that is based on credit. It's not really backed by anything tangible, like John Exter said. We've got I owe you nothings. We've had it for over 50 years. So we've inflated a huge credit bubble that's reflected in the Nasdaq stock price. It's reflected in the bond market through bond prices and very low yields. It's reflected in relatively moribund commodity market for the last 10, 11 years, I would say. It's reflected, yes, in speculation in things like cryptocurrencies. It's reflected in low mortgage rates and speculation in housing prices. So with that, let's look at the hard assets versus the paper assets, right? And we've looked at that this year so far, the shift from paper assets to hard assets. And we're going to do a bit of an update here. So we're going to start looking at how the paper markets did yesterday. Of course, it wasn't a great day. It looks like the move lower in paper assets is resuming. We've had a little bit of a lull, I would say, since the beginning of March. But yesterday, the Dow, for example, was down 981 points, just under 3%. S&P 500 was down 2.75%, and the Nasdaq was down 2.5%. And yeah, bond markets were pretty steady, but we're now going to move to some charts. And after that, we're going to look at year-to-date comparisons between paper and hard assets. So let's look at the Nasdaq chart, because I think the Nasdaq chart, even though it's only going back to 2017, and I could go back further and it looks even more of a bubble, but this looks pretty much like a bubble anyway. But what I wanted to show you here, the Nasdaq 100 chart, is that back in 2020, yes, there was a sharp correction lower or crash in March of 2020. Then we resumed. Yeah, we've kept going up, made a top last year. But now it really looks like a big top is forming, like a head and shoulder top. And as I said, there was that lull from mid-March, and it now looks like we're going back down. So you can clearly see that here that 13,000 is the key level for the Nasdaq. So this is the epitome of paper assets, the bubble that I was talking about earlier. Now I want to look at the 10-year note future, the price of it, not the yield. Yes, yields are rising, and the prices are dropping. And I think this is really important as well. As I said, this credit bubble, which has been really pushed and encouraged by the central bankers, by Wall Street, by governments. The monetary and fiscal policy have complemented each other. Maybe the cycles have helped as well. But every good thing comes to an end. And when we come to an end of something that's really good, that's when we get these financial or any kind of disaster or maelstrom. And yeah, so I've got here a monthly chart going back to the early 80s, around late 1982. And you can see that we did break this trend line in the 10-year note future. Is a continuation chart of the 10-year note future, which by the way was one of the futures that I traded a lot for my clients, besides the German Bund future. So I'm really familiar with this market. But we broke that trend line back in 2018, but it came back above the trend line, and now you could argue, yeah, we've broken that trend line. We might go back, but it looks more than just like a false break. It looks like a definite break, and I think it's going to be really hard for this price to go back above that trend line. So that's a really bad signal. And why is that important? Well, because it means that yields, in my opinion, are going to keep going up in the medium to longer term. Yes, they could move lower in the short term, and higher yields means that the cost of credit is going to go up. So that 50-year plus credit bubble that we've had since the Nixon closed the gold window and we've gone on a I owe you nothing system is going to reverse, and it's not going to be pretty. And you want to be on a ship made of hard assets, I think. I'm not giving advice here. This is what I think, and this is what I've been doing. I've been preparing for this. Yes, maybe I was a bit early. I thought this was going to happen after the '08 crisis, and I was prepared for it. I had stacked, but it didn't really, and it didn't happen, but I still survived. But if it had happened, I would have survived as well. So this is what I'm trying to say here. It's better to be prepared, even if it doesn't happen. But I honestly and truly think we're near that point right now. Let's keep going anyway. So now we come to gold. And I think gold, yes, it's the most marketable commodity. It's a monetary commodity, mostly. Well, almost totally, I would say. There is some gold used for industrial use, but it's more of a monetary asset. And I think it will be, along with hard commodities or commodities in general. And I think oil is a big part of the consumable commodities. That's the important part. Gold is more of a monetary commodity, of course, alongside silver, of course. But this chart here shows me that, yes, gold is probably set to go a lot higher. Gold will benefit from the move away from credit-based system. When credit gets hurt, when credit is destroyed, gold in relative terms becomes worth a lot more. And I think that's why JP Morgan said when he was asked what gold was, he said gold was money and everything else is credit. And if credit is doing well, gold is not going to do as well. But if credit is being destroyed, gold and other hard assets, I think, are going to do well. So what the chart does here, it gives me the navigational part, the technical part. It still looks good, in my opinion. It looks like a teacup. It looks, despite all the mayhem in the markets this week, gold still held above the 2011 high. And we're still breaking out. It's just taking a while. The fundamentals, of course, the weather and the currents, as I said, still look really good for gold. And now to the dollar index. And people need to realize that almost 2/3 of the dollar index is the euro, and then the yen and the British pound. And those currencies, yeah, they're having trouble. And the dollar has gone up. I admit, the dollar index, but it's gone up mostly by default, not because the dollar is strong, not because the US stock market is strong, or because the US bond market is strong. And even so, if you look at what we've done in the last few years, we're really not going anywhere. We're trading sideways in the dollar index, while gold, of course, since 2008, has gone from 1,000 to almost 2,000 right now. Yes, the dollar index has gone from 70 to 101, but I would say doubling is a lot better than the performance of the dollar index. And to be honest, I don't think any of the fiat currencies are going to survive their cruise or their trip around Cape Horn. Yes, the dollar might be doing a better job right now. It looks like it's gonna go around the Cape, but I think they're all gonna fail around the Cape. They're all gonna go down. So crude oil, as I said, I think crude oil is an important commodity. It's not the most marketable commodity because it's not money, but I think it reflects, reflects the rebalancing of the scales from paper to hard assets. And as you can see in this chart, yes, in March 2020, oil fell to almost $10. We also had oil, the WTI trade to minus 37, mainly because no one there wasn't any place to store oil in Cushing, Oklahoma. So they were trying to give it away because the storage was too expensive. But anyway, it has been volatile, but I think the trend is still higher. So that's crude oil. Next chart, you might ask why you're looking at the British pound. Well, I think the British pound is a good proxy for when we have financial maelstroms. And if you look back at the 2008 crisis, look at what the pound did. It had been up to almost 211, like right at the top at 211. And then by the time everything had collapsed, the British pound had fallen to 135. Yeah, and then of course they threw everything at it, QE, and the pound stabilized. And we dropped here from 2015 to 2017. That was mainly to do with Brexit. But then in March 2020, you can see that we had a huge drop from around 135, which seems to be a key level here, down to almost 110. It went down to 114. Then they saved the system again, threw everything at it, and the pound rebounded. But it seems to have topped now as well. And it doesn't look very bad on this chart because it's a monthly chart. But if you look at a weekly and a daily chart, it looks pretty bad. And I think that's a bad signal for paper assets, the British pound turning south. Next one is the commodity index, the CRB index. Yes, I said earlier in the video that commodities have been very moribund, I would say. They have since the 2008 crisis. They've been, and that's helped the credit boom because it's kept consumer prices low. It's kept what they call inflation low. But now, ever since the bottom it made in March 2020, which went through all the bottoms in the last, since 2003-04, commodities are on the run. Yes, they're going to be volatile. They're going to be certain commodities that are going to do well at certain times. But I think this is far from over. And this is all to do with the shift from paper to hard assets. And I think this is like the currency collapse. It's like the hyperinflation that we're going to get. And if you look at Weimar Germany, the German stock market did well in the hyperinflation, but I would say it was mostly the industrial or the companies that had hard assets in Germany. And I think this is the way it's going to be this time around. And it might not look like possible, but I think that's what's going to happen. And that's why we're seeing the Nasdaq teetering right now. And I think, yes, we've seen the miners and the commodity stocks come off in the last few days, but I think they're headed a lot higher because there's so much credit and paper assets out there. And when people try to get away from that for safety in hard assets, even when they take a few percentage points of their holdings from paper into hard assets, it's going to put a rocket up hard assets. And So I think there's still a lot of room for the CRB. I think it's going to break that '08 high very easily eventually, and it's going to be years of this shift to hard assets. Last chart here, but not least, is silver, one of our favorites, I guess. And I just wanted to show you here that how important the 21 level is. And that was the high in '08. And at that time, gold went up to like 1,000. Silver was just above 21. Yes, it went up to almost 50 back in 2011. And if you look at the correction or the kind of dump we had in March 2020, we're still basically double that level because we got down to around 12. Right now we're at 24. So yeah, silver has been frustrating, but I think silver is like the dinghy that's, or the tender boat that someone left instead of putting on top of the hard asset ship. It's like trailing, it's connected to the hard asset ship, and it's getting rammed around. Sometimes it's been able to go faster than the big ship, but it's going to survive. And eventually, when we reach, I would say, calm seas, the dinghy is going to go a lot faster because it's going to be a lot calmer. So that's what I think about silver. And now, just wanted to sum all this up with some data, some year-to-date numbers for all these hard assets and paper assets. So on the left-hand side here, you notice it looks very red. Well, it's because it's paper assets. So I've got the major indices, stock market indices here. You've got the Dow Jones year to date is down 6.95. You've got the S&P, it's down 10.37 year to date, and the Nasdaq 17.93. And we've got like other countries indices. We got the TSX virtually unchanged. I guess you got the hard assets in Canada, the miners still doing well. Brazil still up year to date. The Bovespa, Brazil is a major producer of real things, 5.97%. You see the Italian, or that's the Mexican, is unchanged. The DAX, German DAX, is down 11. The FTSE is up. Why is the FTSE up? Well, maybe because of the weakness in sterling. And also there's a lot of miners and the commodity stocks in the FTSE 100. But you look at the CAC in France is down 8, and the Euro stocks down 10.66. And then we move to the TLT, the long bonds ETF. It's a proxy for bonds of an average maturity of 20 years, I think, and that's down 16.85% year to date. And I don't think this has happened in the last 30 years where stocks and bonds are doing so badly. Usually when stocks in the last 20 years are having a tough time, bond prices go up and yields go down. But it looks like they're both going south. They're both having a tough time around Cape Horn. So we also have the high yield corporate bond ETF, which is more like the junk bond part. That's down almost 9% year to date. And then we've got another interesting one here is the KBE, is the bank S&P Bank ETF. That's down 11.39. There's nothing more closely related, I guess, to the credit market than the banks. So that's a bad sign as well. And then we've got the mortgage-backed securities. That's to do with the mortgage bonds and the mortgage market. That's down 8.67, and that's related to real estate. And on the other side, as you can notice here, everything's green. Despite the correction or the rough seas we had this last week. Some of you might have gotten a bit seasick. Yeah, I felt a little nauseated a little bit. And yes, I did get seasick sometimes when I sailed with my dad. And one of my sisters, though, never got seasick. My dad didn't get seasick. But I think it doesn't matter if you're a good sailor or not. It's more to do with your metabolism. So moving over to the right, to the hard asset part, you notice that it's green. We got GLD, and I've used GLD because it's easier to get year-to-date numbers. That's up 7.11%. Even though we had a rough seas last week, we're still up year-to-date. We've got the Invesco Bloomberg Commodity Index. That's still up almost 30% year-to-date, 28.86%. And then we got the SLV, which is the iShares Silver Trust. Again, I used that because it's easier to look at the data. And that's still up 5.34% year-to-date. So the dinghy is hanging on there, or the tender boat. And then if we look at the GDX, the VanEck Gold Miners ETF, yes, we've come back below 40. That was an important level technically, but we're still up 18.21% year to date. Yes, I think it's still going to be rough seas out there. We haven't rounded Cape Horn by no stretch of the imagination yet. And yeah, the rough seas are going to continue. We're going to have rough weather. Sometimes we're going to be throwing up overboard, but I think you need to hold on. I think the paper ships have no chance. So if you enjoyed this video, make sure you hit the like button. Please share it far and wide. Think about subscribing to my channel if you haven't yet. And you can also follow me on Rumble, Twitter, Facebook, and all these other platforms below here. I wish you all a great day. Take care. Bye.